Okay, so in this role of lender of last resort, yeah, a bank has a liquidity issue. It turns around to the Fed, and the Fed says, "Okay, we will lend you a certain amount of money to." And what are the commercial terms that the central bank lends it to?
Great question. So every central bank operates differently. From now on, I just assume we're talking about the Fed.
We're still with the Fed now. Yeah.
So the Fed has something called the discount window, and the discount window provides loans to commercial banks under set terms. So it's the primary credit rate is what they offer to most banks. There's also a secondary credit rate that's a little bit higher. And if you were a bank, what you would do is you would have a relationship with your local Federal Reserve Bank, and you would pre-position collateral there because every loan from the Fed is secured. So you would say post mortgages you have, post corporate debt you have, and the local Federal Reserve Bank would look at that and figure out, give it a credit rating and then lend against that. But the rate that they offer, though, is set by policy. So when you're thinking about the Fed raising or lowering rates, that's one of the rates that they lower, what they're willing to lend at the discount, the rate that they're offering at the discount window.
What's the relationship between the general interest rates and the rates that the Fed lends at?
So the Fed controls the overnight interest rate. When you hear about the Fed raising or lowering interest rates, what they're really doing is that they're raising or lowering the overnight interest rate. The discount window rate is also an overnight interest rate, so it's the same rate that they're raising or lowering. There's a spread, of course, but it goes up and down at the same level, to the same extent. But when you're looking longer beyond the overnight into, let's say, the 5-year or the 10-year interest rates, that's a little bit more complicated. So because the Fed only controls the overnight rate, though, what does it do if it wants to influence, let's say, the 5-year rate or the 10-year rate? So to some extent, just by adjusting the overnight rate, you can influence the 5-year rate. Let's take a look at this from an investor's perspective. Let's say I'm an investor and I'm going to lend you some money. How am I going to price that? Well, on the one hand, I can always take my money, let's say I have $100, and lend it to the Fed overnight. Okay, then I can get that from the Fed. Now, if you're asking for, let's say, a 2-year loan, well, I can lend to the Fed every day overnight for 2 years, let's say at 5%, or I can lend to you. Whatever rate I offer you has to be higher than what I can get from the Fed, risk-free overnight for the next 2 years. So I have $100. I can lend to the Fed at 5% right now overnight, or I can lend to you for 2 years, right? For 5 years overnight, over 5 years, $100. How am I going to price that? Well, it has to be my expectation of what the overnight rate would be from the Fed over the next few years, because that's my risk-free alternative. And so by shaping that expectation is how the Fed shapes interest rates from, let's say, the first year all the way up to the 5-year. Beyond that, though, it's more supply and demand, and that's where quantitative easing comes in. They want rates to go lower. They just go and they buy a whole lot of, say, 10-year treasuries, making the price go up, yields lower.
Is there ever a case that it drops below that Fed fund rate, or is that effectively like the floor?
It can, but so far, the Fed has really good control over the overnight rate because the people who are willing to lend in the Fed funds rate, they can always just go to let's say, invest in the reverse repo facility, which is another control tool. But to your question, though, the Fed has a very good control over the overnight rate. That's never a problem for them.
Well, why would the Fed borrow from the banks when they can print money? So you said I can lend to the rate.
Yeah.
Why would the Fed do that? Why would the Fed pay an interest rate?
Just to control interest rates. So
to control
just to control interest rates. So technically, so we have this reverse repo facility, which I'm sure many of you have pointed out. Right now, it's above $1 trillion. That's the Fed technically borrowing $1 trillion from the private sector. They're doing that to control interest rates because if the Fed is willing to borrow at, say, 5%, then why would you ever lend to anyone below 5%? It provides a floor to overnight interest rates. It's a mechanism for rate control.
Danny, can you explain the reverse repo?
It's like a pawn shop.
There you go. It's a pawn shop. Okay, so if I was, say I'm a banker Pete, and I want to borrow from the central bank, which is yourself.
Yep.
And I've got a liquidity issue, so I post the collateral.
Yep.
You lend me $1 billion. When I'm ready to pay that back, do I pay that back and have my collateral returned?
Yes, you do.
So the collateral is an insurance.
Yeah.
When I pay that billion back, will the central bank then burn that? In that they created it.
That's exactly what happens.
And when they're burning it, are they really just burning zeros?
Well, you don't need to burn anything. You just kind of go to the computer and type. Yeah, that's how it happens.
So they can essentially magic money out of thin air to deal with my liquidity issue.
That's exactly what they're supposed to do. And in fact, that's what a commercial bank does when they make a loan to you.
Yeah.
They just type out money and create money out of thin air. It's provides extra elasticity to the financial system.
But there's limits to how much they can print out of thin air, right? It's not related to how much they have in reserve. So they can just create any amount of loans they want.
Are you talking about the central bank?
My bank, Bank of Peak.
Oh, Bank of Peak. So there are limits to what you can do. They're not really, so they're regulatory limits, really. So
yeah.
Being able to create money, obviously, is kind of a dangerous superpower. So you have to have it well regulated. So there's a ton of regulation that goes into this. If you're a really big bank, in fact, you actually have Federal Reserve employees on site inside your bank all the time, just making sure that you are in compliance with regulation.
But could I also use the central bank for other reasons? So I may have a liquidity issue, but say I've got some commercial opportunities. I'm like, oh, you know what? There's another bank down the road. I want to buy them. Can I then post collateral to the Fed and essentially treat it like a loan and go and use that to expand my business? Or can I only use it for liquidity?
You can, and they'll get really angry at you. That's why no one does. What happens, so if you want to go to the discount window, when people have problems, they try to go look for cash at any other source. Going to the Fed's discount window is the absolute last resort. There's a strong stigma against that. Usually people think of, if you're going to the Fed, you must be in serious problems, right? So there could be a crisis of confidence where people start to go and, this bank is probably going to go under because they're going to the Fed. I want to pull my deposits. So it's a really bad sign. It's a really bad business for a bank to do that. And of course, you would have regulators strongly dissuade them and say, you really shouldn't come to us unless you really need it.